Welcome to Talk Tickers. We're here to cut through the noise on 1-800-Flowers.com's latest results. That's ticker FLWS for their fiscal Q4 and the full year 2025.
Yep.
It's definitely a critical moment for them. There's a pretty significant strategic overhaul happening.
Absolutely. It was, a challenging year for them, no doubt. But we're also going to unpack the detailed plan, the blueprint, really, that the new management team has laid out for a leaner, more agile future.
Okay, let's dive straight into those numbers then, because they really set the scene. For Q4, revenue came in at $336.6 million.
Right.
That was actually a slight beat versus what analysts expected, so, a little positive there.
Slimmer, maybe.
Exactly. But the non-GAAP adjusted EPS, that's earnings per share, adjusted for certain items, well, that was a loss of $2.69.
Oof.
Yeah, and that missed expectations by a pretty wide margin, about barely 18 cents.
And that miss really tells the story, doesn't it? Even with the slight revenue beat, the market reaction initially was, clearly concerned about that bottom line.
Definitely cautious.
Very cautious. That widening loss just highlights the profitability challenges they're still facing, despite maybe moving a bit more product.
So digging a bit deeper than just Q4, the full fiscal year 2025 really shows the scale of the issues. Consolidated revenue for the whole year was down 8% to $1.69 billion.
Yeah, an 8% decline.
And in Q4 specifically, that gross margin was really squeezed. It dropped 290 basis points compared to last year, down to 35.5%.
That's a significant drop, and it really underscores what management kept calling a highly promotional environment. Lots of discounts, trying to drive sales.
Right. And then there was adjusted EBITDA for the quarter, a loss of $24.2 million. That's quite a bit worse than the $8.8 million loss they had the year before.
Exactly. And you also have to factor in the lingering effects of those operational problems they had, particularly with that order management system, the OMS implementation.
Yes, the OMS issues. Management said that weighed heavily on margins and, crucially, the customer experience earlier in the year.
It did. And, adding to that picture, there was that big non-cash impairment charge for the full year, $143.8 million on goodwill and intangibles.
Wow, $143 million. What does that really signal?
Well, it's essentially a reevaluation of the value of companies they bought in the past. It signals that, given the tough operating climate, maybe those acquisitions aren't worth what they once thought. It's like clearing the decks,
A reset. Okay, so amid all this, there's new leadership. Adolfo Villagomez became CEO back in May 2025.
That's right.
And he's rolling out this celebration strategy. Sounds ambitious. What's the core idea?
It really aims to fundamentally transform the business. The goal is leaner, much more customer-centric, and importantly, data-driven. He laid out 4 key priorities.
Which are?
Driving cost savings, that's a big one. Strengthening that customer focus we mentioned. Expanding beyond just their traditional e-commerce. And boosting talent and accountability within the company.
Okay, that focus on customer centricity and data. It brings up their marketing, right? How does that fit in?
It does, and this is interesting. Management basically admitted their old marketing approach, focused heavily on the bottom of the funnel, trying to convert someone right at the point of sale, was inefficient.
How inefficient?
Sometimes the cost to get a customer actually exceeded the profit margin on the transaction itself, not sustainable.
Ouch. So what's the change?
They're shifting to what they call a full funnel approach. So balancing building brand awareness, actually acquiring new customers, and then retaining the ones they have. And the key metric shift here is focusing on variable contribution margin, not just total revenue. They want profitable growth, not just volume at any cost. That's a pretty significant change in mindset.
That makes sense. And this expansion beyond e-commerce, what does that look like?
Well, they're pushing into new channels quite aggressively. There's an expanded partnership with Uber Eats, using local florists for on-demand gifting.
Okay, the convenience factor.
Exactly. And then there's physical retail. They're experimenting. 3 pop-up stores inside Macy's, 5 mall locations for Harry and David, 1 for Things Remembered.
They're testing the waters. Are they getting good data from that?
Apparently so. They mentioned their existing store out in Huntington, Long Island is, quote, doing quite well. So they're using that, plus these new pop-ups, to figure out the right store formats and what products work best in a physical setting.
Interesting. And how does this connect to the bigger picture?
Well, it's all about diversification, right? Meeting customers wherever they happen to be. And it ties into this focus on self-consumption.
Self-consumption. So not just gifts.
Exactly. Think buying Harry and David cookies or coffee for yourself. Or maybe flowers without the fancy vase, just for your own home. It's about broadening the occasions, personalizing assortments.
Okay. Like subscription boxes, maybe?
Potentially, yeah.
Yeah.
Especially for brands like Harry and David that really lend themselves to that kind of regular purchase model. It unlocks growth beyond just birthdays and holidays.
Okay, good to hear. They're also tackling those operational issues head on. They said the OMS system problems are resolved now.
That's what they stated. They claim it's actually performing better than before they implemented it, and crucially, they've built redundancies into customer care.
That's a big claim. The proof will be in the holiday season, I guess.
Absolutely. Peak season execution is paramount for them. They also admitted, pretty frankly, that their expenses hadn't really adjusted downwards in line with the lower revenues.
A common problem when sales dip. So what's the plan there?
They've got a cost reduction plan aiming for about $40 million in annualized savings. They said $17 million is already implemented.
How are they finding those savings?
They brought in external consultants to help speed things up. They're looking at, well, everything: company structure, supply chain, procurement, IT costs. They specifically mentioned centralizing procurement as one way to simplify things and use their scale more effectively. It sounds like a pretty thorough review.
Okay, so looking ahead to fiscal 2026, they're calling it a pivotal foundation-setting year. What does that actually mean?
It means manage your expectations, basically. It signals this is a multi-year turnaround.
And notably, no specific revenue or EPS guidance for the year.
Right. That suggests they're really focused on the internal restructuring and strategic repositioning right now, maybe less on hitting specific short-term financial targets. Getting the fundamentals right is the priority.
Makes sense. And capital expenditures, CapEx.
Expected to be slightly down from last year, but it will include investments in those new physical retail spots they're testing out.
So investors will be watching closely for signs of progress, even without hard guidance.
Definitely. Things like sequential margin improvement, seeing those margins tick up quarter by quarter, and, as we said, a clean peak season execution. Those will be the concrete indicators that the strategy is starting to work.
Okay, let's shift to the investor context. The market reaction to these results. It wasn't great, was it?
No, it was pretty swift and negative. The stock dropped significantly in pre-market trading, something like 8% to 12% down.
And how did it end the day?
It opened the regular session down about 6.8%. Closed the day still down 2.8% at $5.18. And importantly, trading volume was way higher than average, around 1.67 million shares.
So a lot of investor attention, mostly negative.
Yeah, it points to a cautious, maybe even skeptical sentiment. Despite the new CEO laying out this clear strategic plan, the market seems to be saying, okay, show us. They want proof of margin recovery and solid execution.
It's a show me story.
Exactly. And you have to remember, FLWS has really underperformed the wider retail sector lately. The XRT retail ETF is up over 16% year over year, while FLWS is down nearly 30%.
Wow, that's a stark difference.
It really highlights the deep concerns investors have, concerns that need tangible results to overcome.
And they mentioned that highly promotional competitive environment. That's obviously a big
A
factor.
huge factor, putting pressure on everyone's margins. They also talked about broader trends, like how customer buying habits are changing, moving beyond just traditional search.
People finding products differently.
Right. And the ongoing impact of commodity prices, though they said many are coming back down, except cocoa, apparently. Plus, a persistent $15 million headwind from tariffs.
So how do you compete effectively with all that going on?
Well, that's where the new strategy comes in. The focus on data, that full funnel marketing, expanding into marketplaces and on-demand delivery like Uber Eats. It's all about adapting. It's a pragmatic approach, meet customers where they are rather than just trying to force them to your own website. And they see the competition as pretty broad, not just one specific rival causing problems.
So moving forward, what are the key things investors should watch for? The catalysts.
Okay, definitely updates on holiday readiness. Is that OMS system truly stable? How are the marketplace and last mile partnerships like Uber Eats scaling up?
Any signs of further restructuring?
Possibly. Any further portfolio actions or deeper cost-cutting moves would be noted. And then, of course, broader macro factors, things like potential interest rate cuts or just a general improvement in consumer confidence could provide a tailwind.
But fundamentally, it comes down to execution this year.
Absolutely. Management's credibility really hinges on delivering tangible results in this foundation-setting year. Sequential margin improvement and smooth peak seasons are non-negotiable, really, to show the strategy is actually translating into better financial performance.
All right, now for something a little different. This is our not financial advice segment.
Yeah.
Purely for intellectual stimulation, an outrageous but plausible trade idea. What have you got for FLWS?
Okay, disclaimer up front. This is absolutely not financial advice, just a thought experiment.
Understood.
Given how much negativity seems priced into FLWS stock after this reset, here's a provocative idea. A speculative long call option.
Okay, details.
Maybe targeting a strike price, say 10-15% above where the stock is now, with an expiration date out in mid-2026.
And the rationale behind this high-risk play?
Well, the new CEO, Villagomez, has set the bar incredibly low, framing FY26 as purely foundation setting with no hard targets. So the thinking is, if the company simply manages to avoid any major operational disasters during the upcoming holidays—
Just competence, basically.
Right, competence. And if they show even modest early signs that margins are stabilizing because of the new marketing efficiencies or the cost cuts starting to bite, the stock could see a significant short-term pop.
Because expectations are so low.
Exactly. The market often overpunishes stocks like this and then can re-rate them pretty quickly on any glimmer of good news or signs of green shoots, especially after lagging peers so badly. It's definitely high risk, high reward, a bet on basic operational competence meeting very, very subdued expectations.
Interesting thought experiment. So wrapping up our deep dives, we've covered a really challenging fiscal 2025 for 1-800-flowers.com.
Yep, and the big strategic reset under the new CEO, focusing on costs, customer experience, and branching out beyond just e-commerce.
It's clearly a multi-year transformation plan. The path seems articulated, but the market's still waiting for proof.
That's the key takeaway. Caution prevails. Everyone's watching closely to see if this foundation-setting year actually leads to sustained, profitable growth down the line. The journey's just beginning, really.
And remember, everyone, this discussion was purely for informational purposes. It is definitely not financial advice. Always do your own research and due diligence.
Absolutely.
Thanks for joining us on Talk Tickers. We'll catch you next time for another look at the earnings landscape.